Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everyone, to a new episode of This Week in Intelligent Investing. Looking forward to another great discussion with Phil Ordway and Elliot Turner. Phil, let's kick it off with you.
Thanks, John. So I thought I'd try something a little bit different this week. As you guys know, and I think some of our listeners know, I teach an MBA class at Kellogg where it's basically an applied internship in investing and asset management. So we take a bunch of first year and second year MBA students and students getting a law degree and an MBA at the same time. So it's a good cross section of the school, and we place them into hedge funds, mutual funds, pensions, endowments, family offices, all the usual suspects. So they do basically what would equate to kind of a part-time summer internship style project of their choosing and the firm's choosing. And then the other half of the course is they got to come listen to me ramble on once a week. It's not really, but we try to have a seminar and a discussion. So I give a lot of reading, and then there's kind of a discussion, and we do a lot of mental psychological games and mental accounting style tricks to kind of expose their inherent biases and mental liabilities and the things that they didn't know. Because what motivated me to do this 4 or 5 years ago when they asked was just that there was no class like this. When I went through the program. I mean, you kind of make this jump from academia to the real world. And as we all know, the gap between academia and the real world in investing is gigantic. It's probably as wide as any subject you could imagine. And so, the idea here is that I come in as a non-tenured, non-PhD faculty member to say, okay, this is how a fund might actually operate. This is how the markets actually operate, despite what you may have learned in your other classes or from a textbook. And I always just thought it was a huge travesty that we are graduating, legions of MBAs every year who have, great backgrounds. They're very bright, but they really have no grounding whatsoever in the basic principles of asset management. And so my pitch, so to speak, to students has been, look, I don't care if you want to run a fund someday, although that's great. Or if you want to get a job as an analyst right out of school, that's great. And that turns out to be actually only about half of the students that take the class. The other half is, I say, look, if you're ever going to have a senior executive role, you need to understand investment, because M&A decisions, investing decisions, stock repurchase decisions are investing decisions, paying a dividend. All of these decisions are central to your responsibility as a senior executive or as a board member. And, because if you asked your average MBA class to raise their hand, do you ever want to be, a senior executive or a board member or whatever? I mean, it's the vast majority of the class, right? So how on earth can we graduate people and have given them no preparation whatsoever for one of the most central roles that they're ever going to face? And even just at a more basic level, I mean, it's got to be somewhat embarrassing and lead to a lot of mistakes in real life when you come out with an MBA degree and you really don't have the first clue as to how you should be managing your personal portfolio. And so I don't see my role at all is to get up there and preach the high sermon on value investing with a capital V. And in fact, I do just the opposite. And I certainly don't get up there and tell other people how to invest their own money. But I do try to expose how little they know and try to start pointing them in the right direction on things that they should be reading. So we can talk a little bit about, the reading and the materials that I assign and what goes into that. But so today's actually our last class. And so one of the things that I distribute at the end is what I try to keep to just 2 pages, just the front and back of one piece of paper. And these are the big ideas in any investment process. So whether or not you're managing a not-for-profits endowment, whether you're a CFO or a CEO of a company making capital allocation decisions, whether you're managing your own personal account or retirement portfolio, these are the kind of the big things that you would need to know or need to implement in your process. And so backing up a step, I mean, we actually start by trying to frame the discussion the very first week of the class. So I start with what I call an investment belief survey, where I asked the students to respond to just, 10 or 15 questions about some basic precepts in investing, like the value of any financial asset, a stock, a bond, a farm, an apartment building, is the discounted present value of future cash flows. And thank God, I think I've gotten almost everybody to mark true on that one. But then we get into some other stuff. Is it possible? It is possible to get an informational edge in most or all of my investments. And, a decent number would say true to that, which I would take some issue with. I don't think it's true in most or all. Growth is a component of value, and a surprising number of people check false at the beginning of that. I actually put Ben Graham's old line: investing is most intelligent when it is most business-like. And nobody has any idea what I'm talking about, which is kind of interesting. You have a strong, well-informed opinion about the future cash flows inherent in a certain investment. You make a commitment to that investment, and a month after making your investment, the quoted market prices decline by 30%. There's been no news or other developments that are relevant, and the riskiness of this investment has increased, decreased, stayed the same. I don't know. And the answers to that are all over the board, which is really, really interesting to me. On the psychological side, the one thing that stands out about this group of students, and again, they're all pretty much in their mid to late 20s, is how open and willing they are to share ideas publicly. So, Twitter, of course, and just about everything else you could imagine. And so I put on there, making your beliefs or your investments known publicly is likely to make your conclusions more easily changed or less easily changed. And despite reams of evidence and psychological studies showing that it makes your opinions less easily changed, most of the students actually believe it makes you more able to change your mind, which I think is really, really interesting. A good number would agree that it is possible to pay too much for a great company, but there were some that would say false. Surprisingly, everyone acknowledges the rise of passive and indexed investment, but still think that fundamental security analysis is both relevant and potentially even more relevant as that power gets concentrated into fewer and fewer hands. So anyway, those are kind of the beginning, of course, things that we lay out to kind of frame the discussion. And then as we get to the end of it, the things that I'm really trying to, pound in, so to speak, because again, in an MBA course or in life in general, right. And so I kind of found that if I don't have a relatively simple, digestible thing that can't be almost a desk reference, right? Something that they can put their hands on easily and keep coming back to rather than just forgetting it, right? Because I literally probably send 20 of Michael Mauboussin's papers, right? And every one of them is awesome. And every one of them is 30 to 60 pages long with footnotes. So I don't know how much they get read, and I don't know if they'll get revisited as much as they deserve to be revisited. But if I can have kind of one page of basic principles and tenets, I think it might serve the purpose even better. So the things I'm including, and I want to hear, John and Elliot, what you guys would include on a page like this, is I start with just think for yourself. You've got to be able to figure it out, and you can't stop asking why until you have the real answer that satisfies you. It's not good enough if somebody else has the answer. It's not good enough if you can kind of get halfway there. You really have to think for yourself and know what you know and know what you don't know. So the second basic principle is that overconfidence is deadly in this game, and that it's way easier to achieve success by avoiding stupidity rather than being the smartest person in the room. Try to learn something every day, read as much as possible, track and measure what you're doing, set daily and weekly quotas and goals. Never assume everything. I always like Bob Caro, the author, turn every page, turn every damn page, that kind of trust but verify kind of model to really keep digging. Inverting is obviously, a well-known principle. It's been popularly espoused by Charlie Munger for good reason, that, sometimes the best way to solve a problem, whether it's in investing or business writ large or life, is by looking at it backwards or upside down. We actually also do toward the beginning of the course, an exercise in confidence intervals where I play the game where you get 10 questions, and the entire goal is to make sure that at least 9 of your answers fall within the correct range. So it doesn't matter how wide the range is, but you want to be in that range. So I would say, how far is it in miles from the Earth to the moon? And it doesn't matter if your range is 10 miles to 1 trillion miles. You just want to make sure you're in that range 9 out of 10 times for the 10 questions that we ask. And yet people can't resist the psychological urge to show off at least a little bit of knowledge and tighten that range way too much. And so I'll ask a question like, how long is the pregnancy of an elephant? And people will assume that, oh, there's no way it's more than 12 or maybe 13 or 14 months. And that's not correct. It's like 20, I can't remember off the top of my head, 22 months or something. It's kind of ridiculously long. And so everybody gets that wrong. Or, how much does 5 gallons of water weigh? And they start thinking about it, and they put this ridiculously precise number on there. And the same is true in investing, right? I say we also do a lot of blind valuation exercises where I'll present, Tesla with no name at the top next to some other car manufacturer with no name at the top. And it's literally just the last, 5 or 6 years of historical financials and maybe a couple of years of projections. And I'll say that these are both, maybe I'll give kind of a general description of the industry, but I won't name the name. And we've done this on the podcast, right? We did this last year a few times. And it's amazing how precise the estimates are. And the answer I try to tell them is like, you don't need a precise answer. You need a range that's correct, right? And that seems to have maybe started to sink in. I'm not sure. What else is on the list here that's important? I think the ability to hold two competing ideas at the same time and not have your brain melt down is huge. Many, if not all, aspects of investing have ideas that seem to contradict each other. You have to be able to learn to reconcile those contradictions and move forward. Many of the great failures, or even most of the great failures in investing, seem to come from losing focus on what it is that you're trying to do, right? So you're not trying to impress your friends. You're not trying to raise the most amount of money in a short period of time. You're not trying to minimize your tax bill every year. You're trying to make the best risk-adjusted decisions you could possibly make, right? For whatever your goals are in that investment program. And people just seem to take their eye off of that ball an awful lot. We talk a lot about the difference between pricing and valuation. So multiples can be useful in a pricing exercise, and they can be useful as a shortcut or a proxy to valuation, but they are not, in fact, valuation. And it's dangerous to confuse the two. It's just as dangerous to confuse speculation and investment, right? There's nothing wrong with using multiples. There's nothing wrong with speculating, but it is dangerous to confuse the two with what they're often conflated with, which is investment and valuation. Valuation must consider the business's competitive environment. It must consider the people involved. The best process is always going to combine man and machine, right? So there's obviously a strong case to be made for quantitative investment only, but this gets back to this notion that, business is most intelligent, or investing is most intelligent when it's most business-like. And, again, I think totally removing the human element from business is never something that's made sense to me. And business is made up of people, and I just don't know how to do that. One thing that seems to blow their mind that just has not been covered elsewhere in finance is the concept of cost of capital, right? I mean, they've been drilled over and over and over again about calculating the weighted average cost of capital and using CAPM and beta and all this stuff. And I sort of throw all that out the window and say the cost of capital is determined by your opportunity cost, right? This is not a new notion for most of the people listening to this probably, but unfortunately it is kind of a new notion for them. And so I say, look, if you're doing a cost of capital analysis and you think you've got it to 1 decimal or 2 decimal places or something, you've wasted everybody's time. I mean, this needs to be a simpler discussion than that. It needs to be based on common sense and what else you can do with the money. We talk a lot about psychology. We talk a lot about market history. We talk a lot about incentives and how important that is. Reflexivity gets almost an entire week of its own. One of the more interesting discussions we've had is what do you do when you make a mistake? Because in a lot of cases, like I said, these folks are relatively new in their career. They have not had, in general, a ton of failure professionally, right? I mean, for the most part, they all kind of got where they wanted to be in school and in the first job and in life. And so, most of them have not had a failure as an entrepreneur. Most of them have not had, been fired at a job or had a company go bankrupt or something like that. So that's actually a fascinating conversation. And I think if you can teach, or at least tell people to expect the need for resilience, that's a good thing. So, and at the very end, I actually just turn it upside down myself and say, I've named kind of 7 sins of the investment process. So you're going to look at it backwards. Like what were the 7 things you do to make it just horrible. So I would say separating securities, stocks and bonds, any kind of security from the underlying business. I think that's always a huge mistake. Ignoring probabilities or assuming there's only one possible state of the world, right? I mean, that always drives me nuts when people assume that, well, this is the way it happened. It could never have been any other way. It was foregone conclusion. Related on that topic would be ignoring base rates, right? Or using point estimates instead of ranges, right? So when you just assume that you've got this tunnel vision to the truth, that's almost always a huge mistake. Accepting facts, in air quotes, without thought or curiosity, failing to ask why. Reversing the proper order of investment research by starting from the outside and working inward. This is something we also hammer on, which is that, and I actually learned this from Jim Chanos and doing his work on the short side, which is that if you do nothing else, at least get the order of the research right, which is to start as close to the truth as you're ever going to get in what companies are required to disclose legally in a standardized format. Then you move one step out into people that have some connection to the company personally, where they might be biased in one direction or the other. And only at the very end do you go to the most biased people, which are, company executives, other investors, that sort of thing. Because by that point, you need to have at least a little bit of a grounding in the facts to ward off those inherent psychological biases that are going to come your way. Losing sight of 2 or 3 big ideas that matter to any investment, pretty good way to screw up the process. Confusing valuation with pricing and ignoring psychological factors. So anyway, I'll stop rambling there. That's just kind of the highlights of it. I think we can probably, I'll take some of the specifics off of it and try to PDF it, and maybe we can put it in the show notes and share it, and people can chime in. But John, Elliot, what do you guys think I missed, or what are your thoughts?
That's awesome. Like, how incredibly valuable that you do this with the students. I wish I had something as robust and thoughtful as that when I was getting started. I've been thinking about this as well, because each year we take a summer intern, and our intern will be starting shortly. And so, interestingly enough, or I think it makes sense, but we kind of converged on the same kind of documents that we send to get people introduced to this all. Basically, like a link to a bunch of PDFs from Michael Mobson. And I have a reading list that covers a fairly wide range, where it's like about how to think, analysis itself, some market history, and trading side of things. So, 101 to 1 in the stock market, for example, More Than You Know by Mobson, Alchemy of Finance by Soros. And I really think everyone should read The First Tycoon, which is a great biography of Vanderbilt, but really a history of the development of capital markets in the US. So, that's background of how I'd introduced a couple topics or a couple themes that I'd add to your 1 to 2 pager. I think it's really important to think probabilistically. Get out of this, I like it, or, binary, think in terms of likelihoods and try to get better at handicapping those. I'd also, try to impress some people. There's no one best way to invest in markets. A lot of it comes down to knowing yourself, and again, avoid those binaries. I think a lot of people don't realize that markets are not inherently zero sum. I think it's so hammered in on people that your gain in markets has to come at someone else's expense. And when you think of the most, call it basic way that people make investments, strip out markets themselves, like I invest in a company to give them the capital they need to grow, that should be, inherently non-zero sum, where both parties, the seller and the buyer, win together. And you could find other ways of that, but stop thinking of markets as zero sum. And I think you'll have a better, more diverse approach to how to invest. Get really good at listening. I think that's one of the things when I was younger, I'd fault myself for having been a little more keen to, as I'm speaking to someone who's incredibly knowledgeable, trying to think about my next question instead of listening first. You can pause before you ask the next question. It's not bad. Leave your mind open. Don't cloud it with, moving one step forward. Relatedly, I'd say don't be scared to ask obvious questions, because some of the best answers I've ever gotten were asking things that are extremely obvious. And I think that's pretty powerful and underrated. Don't fear mistakes. You talked about this, Phil. Everyone makes mistakes, but what I'd add to that is be self-reflexive and understand your own emotions. Like understand how they create impulses to action, slow yourself down, but be totally honest with yourself if you're wrong. To me, there are two kinds of mistakes in this business. There's one where you lose money because, any investment has probabilities. You could end up in the wrong end of the distribution. And that might not have been a mistake so much as, it's an outcome of what we do. It's a product of investing. But the other kind of mistake is if you make an analytical mistake. You have to know if you've done that. So be totally honest with yourself about where it falls and be able to understand why. Then I think it's important to tell people, and myself this pretty often, being a good analyst is not the same as being a good investor. You could do great work, build the numbers up appropriately, but be terrible at handicapping risk reward and actually putting chips at risk and managing that risk. Managing the risk meaning, exactly what you were talking about, Phil, where, what's the answer to the question of if this investment goes down 30% before anything's changed, right? The market is designed to make you want to act. It's designed to induce you to do what you don't want to do. It's not supposed to be easy. So being a good analyst is not the same as being a good investor. And, a lot of the other points that we're talking about kind of lead to how you could kind of make that transition. But the skills are kind of a commodity. They're easy of being an analyst, not so much of being a good investor. You talked about this as well, but study market history and how capital markets evolved over time. I think it's important to, understand these transactions that are at essence of capital markets and know and appreciate the history of how, we live in a very abstract world today. There are a lot of abstractions that emerged over initial simple uses. And so understand what are abstractions and what's core essence and never lose track of core essence. And then lastly, these are what's come to mind as you were speaking, but I think, acknowledge the fact that tails happen far more frequently than every model would infer. Six Sigma events happen all the time. And, there's something to be said about how we should just understand and appreciate, exactly what Taleb was teaching us in Fooled by Randomness and Black Swan, but tails really do happen. And so you have to be prepared for that to happen and understand and know what you'll do when it does. So those are a few I'd add. And, obviously kind of some are points of emphasis more so than adding to your list, but that's great topic.
I'm going to steal several of these. So I hope you don't mind the lack of compensation or effective
It's all good. That's what we're here for, right?
Of which there are none. Yeah. I mean, I think a really interesting one that I had never thought of was that markets don't have to be a zero-sum game, because I think, I will say this, I was probably a little wrong in what I thought the students' pre-existing biases would be, right? And look, there's some sample bias here for sure, right? Because they're choosing to take this class, but there is not a anti-market or anti-capitalist bent find anywhere in these students, despite what I've otherwise read and heard about, this generation of even MBA students. So, but yeah, I think it's an interesting point, because I do think business schools in any generation, particularly when it comes to investing in capital markets, kind of teach the dog eat dog world. And I agree with you that if you look at it more as markets are there to serve and inform and can also create lots of value along the way, and it's not somebody has to win and lose at opposing ends in a zero sum. I think that's a huge thing. And getting good at listening is such a foundational skill and something to just explicitly focus on and practice, and that's totally missing from this list. That's something I should actually put in there. And I have not, again, most of these students, at least in the next couple of years, are probably not going to jump directly to a portfolio management. Although a couple of years is probably overstating. That's actually possible. Maybe not on day one, but yeah, I agree. We've seen there's such a huge difference between being a good analyst and being a good investor, or even just analyst versus portfolio manager kind of dichotomy. That's definitely something to check on, because that's a huge one. John, what about you?
Yeah, I'll just jump in on this notion that markets don't have to be zero sum, because not only do they not have to be zero sum, but they're definitely not zero sum. Otherwise, we wouldn't need markets, right? I mean, think about it. If they were truly zero sum, they would add no value to the economy, and we wouldn't need markets. And the whole function of markets is to allow for intelligent capital allocation to businesses that can invest that capital at attractive rates. So, you could say that day trading is zero sum, but primary issuance and kind of the capital formation part of markets is definitely not zero sum. Now, capital can also get destroyed that way if you if you have businesses raising capital that don't deserve it, but investors falsely fall for those stories or what have you. But they're definitely not zero sum. I'd say for me, as an investor, it's really valuable to have a capital allocator's mindset rather than what I call a small fish mindset. And I write about this in my book as well. I think for most investors, the amount of money they're investing is so small that they're never going to own a big chunk of any public company. So you can fall into this small fish mindset that you're just thinking about your own purse and how much you're putting in each company, and you're not thinking about how much of the company you actually own. And the latter is really important. So related to that, I would say invest only in a company if you actually would feel confident buying the whole company and feeling like you'd get a good return from buying the whole company. It means you need to really know the business well enough to be able to take that step. And secondly, you need to think of it as making money from the business and not from an eventual sale of the stock. Another just basic principle, a psychological principle, the saying, be fearful when others are greedy and be greedy when others are fearful. I think that's just a great reflection of kind of how we sometimes need to go against our innate instincts or the fight or flight, response. Usually, if you kind of just think of that, you don't have to do it necessarily, but at least don't sell something just because it's down. Another thing that I would put on the list, and you might have it, Phil, but incentives, and then specifically management incentives. Yeah. I feel like
they're on there for sure. Yeah, that's a huge one.
Yeah, like insider ownership, what does their compensation look like, and so forth, because you really want management to be as aligned as possible with the owners of the business and not just be agents looking to maximize their short-term take-home pay. So those are just a few, but what a great list and nice additions there, Elliot, as well.
Yeah, thanks to both you guys. There's some really good ones that being fearful when others are greedy and vice versa is something that should be right there at the top of the list. That was a glaring omission on my part. That's a good one.
Terrific. Elliot, should we move over to you for your topic, please?
Yeah, awesome. It was very timely that you mentioned incentives at the tail end there, because it's part of what I want to talk about in this. I want to do something a little different today too and talk through, wouldn't call it a comprehensive case study, but my experience investing in Nuance Communications, because, they're recently set to be acquired by Microsoft. And it's one of the more bittersweet experiences I've had. So I want to touch on both like the setup and the incentives that led to an outcome, I think, that was, which is one to celebrate in some ways, but less than perfect. And so we wrote Nuance in our Q1 2020 commentary, which is also known as our COVID commentary. It was purchased, kind of preceding and during the COVID crash in our portfolios. The stock first came on our radar when a good friend of mine was like, "Hey, this is a stock I think you'd find interesting for a lot of reasons." He's quite familiar with how I invest, and I'd say in a nutshell, we look for we're GARP investors, so looking for growth and value in each investment, but quality as well. So unmitigating about that. And then beyond that, we're looking for, investing around change, whether it be on the corporate level, so companies undergoing change and change in the sector and the space and the industry they're operating in, looking at optionality and looking for something that's a strategic asset in and of itself. And so these three elements of change, optionality, and strategic asset really came into play. So we first got interested in Nuance because there was a new CEO, Mark Benjamin, who came in with a very different strategy than the company had executed and deployed beforehand. They spun off their auto division, Cerence. They had a robust investor day introducing a roadmap for what their strategy was as a business, centralizing around a core in effectively what Nuance does is transcription. But transcription itself, as you know, just from talking to your Alexa or Google, whatever device it is, or Siri, right? And by the way, Nuance powered Siri originally. Transcription itself is a fairly commoditized problem. So the company said, where do we have unique advantages and how can we lean into those advantages and make our product even more valuable for the people who engage with it? And by the way, as a slight digression, this is a story that I think is incredibly relevant for Vimeo that was just spun off of IAC the day before we were recording this, so May 25th. And I think that'll go down as one of the all-time business strategy case studies. And I think it's very relevant for where Twitter is today. So digression over, Nuance was like, how do we add value? What do we do? And how can we make it a product that's even better? And they were building this product called that, ambient clinical or DAX, if you will, is what they call it, their DAX product, which was designed to save time of doctors. It works with the coding systems where doctors are supposed to kind of profile every interaction with their patients and organize it based on what's being done and what they have to follow up on. If you'll think about when you're in a doctor's office, they're typically working in like their Epic or Cerner system, like jotting down notes as they're talking to you. They're not exactly looking you in the eye. If they're not a very good typer, they're probably staring at their computer instead of talking to you. So with this ambient clinical interface, they are actually able to, as a doctor, look you in the eye as a patient, speak with you, and the transcription can not only, get the words right, but know neatly how to organize it. And this creates a recurring revenue, high margin, SaaS-like product from what was, effectively a licensed business. So immense corporate change where they're moving from having to sell each year to an ARR, sticky, recurring revenue, very low churn, interesting product. Now, they hadn't fully launched DAX. They were just slowly rolling it out, finishing their case studies and their beta testing, had implied guidance of about 10 to 25 million in ARR contribution for that this year. But we were gaining a lot of conviction that they could get to 150 million contribution very quickly from this line of business. And then suddenly, as we're gaining conviction in that, the company announces they're selling to Microsoft over a weekend, or at least the whispers and the news started coming out. And then it's like, oh, well, that's great. They're going to pay a whole lot of money. And it turns out, actually, no, Microsoft was going to pay, basically a 15% premium from where it had traded just a couple weeks prior, which really was striking. And I think what it comes down to is, as much as we appreciated Mark Benjamin, incentives matter. So his annual comp was $12 million a year when you add in achieving all the, I'd say, high but achievable hurdles that were in his core comp package. The problem was that he had this $54 million change in control payout benefit. And beyond that, what became clear is Microsoft not only was willing to acquire the business, which kind of kicked in this 54 million change in control, which is, almost 5 years of comp getting paid out all at once. He's going to have a job running this division within Microsoft, which is a really great, high profile, well-compensated position. And, it makes me wonder, like, at what point do shareholders come into play here? Who's the decision ultimately getting made for? And obviously there's a board that's looking over this, and it's a very good outcome from where it had started not long beforehand, but it feels like something that is very bittersweet insofar as you're on the brink of launching the most important product in your company's history, whose strategy was geared toward getting to this moment, to this juncture. And you don't even get to see the fruits of that. All the fruits of that are going to be launched in Microsoft. And so, it's one that I've had a hard time wrestling with thinking about, hey, okay, so we got this right, that there was change, there was optionality, because who would have imagined they'd be purchased for this price, just where they were a year before. And it's proof that this was clearly a strategic asset, because Microsoft's not buying it solely for the actual cash flow, which is quite lush. They're buying it because strategically they think it's a very important area to be in, a business to be in. And they think there's a lot of other levers they could pull in driving their own strategy. So strategically important and interesting in that sense. But how do you synthesize this whole situation? How do you make it something? I have a very hard time thinking of how to feel about this. And I'm curious if you guys have been in any similar situations, how you feel about incentive structures that lead to these kinds of outcomes, how you think about timing, like when you underwrite an idea, you want to see it through. If you're going to hold for the risk side of things, you want to hold for the reward side of things. And, how do you get to a position where you're comfortable if a company could kind of, I'd almost call it a take under, though not exactly that way. So curious your guys' thoughts and see anything similar experiences in your history or what else comes to mind.
Yeah, I mean, I didn't follow this one closely, so I can't add anything specifically to this one. But yeah, it is funny that we talked about incentives leading right up to this, because you just never know what the executives are really cooking up, right? I mean, one thing that sort of jumps to mind is a company I've been involved with, and I still own it, and it's going through an interesting phase right now where the industry is actually booming. It's related to the home building industry. So the industry is just booming right now, but it was a long time consolidator, a roll up in the industry, and the 80 or 81-year-old CEO had retired a couple of years ago and handed the reins to his number two, and this guy had come up through the business. He was the COO, and now all of a sudden he took over as CEO, and he was continuing to do the same good job. And then right before the pandemic hit, so in January of 2020, he announced all of a sudden he was going to retire. Despite being 53 or something, relatively young, he just decided he'd made enough money and didn't want to keep grinding it out and keep doing the work. He wanted to go relax or whatever. And so there was no succession plan in place, which was kind of surprising. And then the pandemic hit and threw everything into the mixer for 6 months. So what did the company do? They went out and rekindled merger talks with somebody that they'd talked to over the years, and ended up doing an all stock transaction where they kind of gave away, way more of the company than I thought they needed to, and gave the CEO job to the target company's CEO. So he got the combined CEO job, which, so again, it's unclear what the original company got out of the deal that was so awesome. I mean, it's kind of similar to this, but in reverse. And, I think the incentives were that, the primary agents that had been involved over the years were all just kind of stepping back from the scenes. They all had their own personal incentives of what they wanted to do differently. And in some ways it was kind of frustrating. So, and I've seen plenty of situations in reverse. I mean, I'm not saying this was malfeasance or there are any bad actors here, but it can certainly end up that way. I mean, we've certainly seen when companies get into any sort of financial distress, there can be an element of incentives and panic, or both, reputational issues come into play. I mean, you could get some really goofy outcomes there. And again, that doesn't apply to Nuance, but look, I mean, this is where I get back to, how could you possibly capture everything that's going on in this situation by looking at the historical numbers, right? I mean, these are people making these decisions and driving these outcomes. So, and even if you're in the boardroom, you probably only have, 75% of the information you'd want, right? I mean, there's just lots of incomplete information out there. So it's not easy.
Yeah, it's interesting. The example you mentioned is one that was also a roll up, because Nuance was effectively in its earliest incarnation, a roll up of different voice adjacent strategies. And, Benjamin was kind of brought in to clean up and make it right. And I was really enthusiastic about seeing him see it through. And, when I first heard the whisper of the deal before the price, I was like, I tweeted out, I'm actually super excited for Mark Benjamin and eager to see where he goes next, because I really thought he brought, I shouldn't say that in past tense. I think he brings the right mentality and the right ethos. Though, incentives could lead people to do some wonky things or, but the other side of that is perhaps there was something in the situation that I wasn't considering, which is originally, Epic, who's one of the major EMRs, or EHRs, they were working with Nuance to kind of embed the product in their own interface. And it was one of the first times Epic was working with people in this way, with a vendor supplier in this way. And I was pretty excited about that. And very recently, heading into the deal, they announced that they were actually, or had leaked that they were going to be trying to develop these capabilities in-house. As unlikely as I felt their capacities were to compete, perhaps there's something, competitively that inspired this, and that I'm not seeing the full picture. And I think that gets to your conversation last week, Phil, on everything we're doing in investing is facing incomplete information in addition to uncertainty. And if I could go back, I wish we spoke a little more about this idea that the information that we see, we can only paint a mosaic. We're reading between lines in a lot of places. When you listen to management speak, you could talk to 10 different investors and get, 10 different takeaways, depending on who it is. And there's a lot that's challenging when working with information that's inherently faced that way. And I've often mused about how there are certain companies out there who, you could take two companies and they could say the exact different things, but one inherently gets the benefit of the doubt on everything, and the other inherently gets punished for saying the same sort of thing. And it's about, I think, training your investor base, driving your investor base to believe a certain way, on being consistent as management in communication. I think all these things come into play in addition to incentives. Curious how you'd, what are some things that we could tackle to try to make sure that our mosaic's as complete as possible in that sense.
John, you want to tackle that easy one?
Yeah, I don't know about that one. I'll tackle the case study, Elliot, I think is a great one for multiple reasons. You've kind of ultimately framed it up as incentives. So I'll focus on that a little bit. And there's some great Charlie Munger quotes around incentives. Show me the incentives and I will show you the outcome. Or never ever think about something else when you should be thinking about the power of incentives. And we see that over and over with management teams. So just knowing how are they compensated, what are their incentives is so key. Change of control provisions, obviously. Sometimes a company will put in place a change of control provision when they already know that they're going to be working on some kind of a sale. So often that kind of a thing can be used to actually get some information about a potential sale happening at some point. Or another kind of management incentive is if you see management compensated based on EBITDA, managements will tout that. They'll say, well, EBITDA, that's cash flow. Actually, it incentivizes them to take on a lot of leverage, maybe leverage that's ultimately going to come to bite the shareholders. But in the meantime, the CEO is going to make a lot of money because EBITDA can go up for a while as you're levering up the company to do acquisitions or what have you. Elliot, you asked the question, at what point do shareholders get to decide? Because ultimately, you've got the CEO, he's going to be well taken care of at Microsoft. The shareholders are maybe missing up on another good chunk of upside here as the new product strategy gets into the market. And, I recently interviewed Connor Haley at Altifox. He's had two fairly recent examples where companies basically were going to sell themselves for way below fair value. And he decided to become activist in those cases, and he did so successfully. So that's certainly one possibility. There's another example that I'm not very familiar with, but it's a current example with Bergson acquiring Hunter Douglas. This was announced in...
I can take that one.
You want to take that one?
Yeah.
Go ahead.
I literally, that was what I wrote down. I didn't mean to interrupt if you want to keep going, but yeah, that was
I wrote
literally
it
what I
down
wrote
too.
down
Jeremy
to
Raper's
talk
taking
about
them
him.
on. That's an interesting situation.
Well, I find that fascinating. I don't know him, but like there is literally 0.0 effect that anyone like him was ever going to have in this situation, right? I mean, the family already controlled 90% of the voting rights here, 90. And so what's so fascinating is that back in the day, like 20 years ago, yeah, they were already a controlled company back then. They used to be in the US. They took it back to the Netherlands, is where it's based now. But it follows Curacao law, and there's a bunch of opaque Dutch provisions here that actually apply to the corporate governance. But anyway, so 20 years ago, they actually started buying back big chunks of stock in various tender offers, and they got into litigation with, I can't remember if it was Fidelity or T. Rowe, because they were accused of buying the blocks of stock too cheaply. And it's like, all right, well, look, you didn't have to tender your shares if you thought it was too cheaply. But anyway, they stopped doing that for, over a decade. They just said, all right, we're not going to buy back any more shares like that. We don't want to make people angry, I guess, or whatever. So I actually bought some of this stock around this time last year. It was a little bit beaten up, obviously, with the pandemic. People were unsure as to what was going to happen. They were having some of their own operational issues. There was some competition in Asia that looked a little scary. I mean, it was ostensibly a pretty cheap company. And then as I talked to the company, it became very clear that they kind of kept this loaded gun in their back pocket, because there was this tiny little preferred issue. It was, maybe $9 or $10 million of preferred outstanding, but it had super voting privileges. And the only reason they kept it outstanding was because it kept them above 90%. And when I kept pressing the company to say, like, all right, well, why do you need this preferred issue outstanding if you don't care about the ability to be over 90%? Because over 90%, they could effectuate a short form merger and just blast people out at whatever price they wanted to. And, they couldn't give me a straight answer. And so, in a slap your head kind of moment, I actually ended up getting a little bit uncomfortable with what was going on overall. And this was kind of the straw that broke the camel's back. So I sold it last September or October. Not long after I bought it, I couldn't quite get comfortable with making it a really big position. And there were enough things that were nagging at me. I just didn't like it. And then in December, right as Christmas approached, they announced that they were going to buy the whole company. The family put together a vehicle to buy the whole company. And look, they had disclaimed over the years, by the way, that they were never going to do this because they didn't want to raise, whatever it was, a couple $100 million to buy out this 10% stub. And sure enough, that's exactly what they did. And so they offered 64 or 66 euros a share. It had been mostly trading in the 40s and 50s. So it was a decent premium, not crazy, still a reasonably cheap valuation at that price. And there's nothing stopping them, right? I mean, they literally have nothing to answer to but their own conscience in this case, right? And so, all these folks saying like, oh, you're stealing the company, or like, sure, I guess, but like, there's literally nothing different about this situation than any other acquisition, or certainly any of the 1,900 different Liberty Media transactions. I mean, this is like straight out of that same playbook. And yet last week, or on Saturday, I think it was, they came out and announced that basically because they feel like it, they're going to raise the price to 82 euros a share. And it's just amazing, right? Because there is absolutely no legal recourse. There is absolutely no remedy. And they just decided to do it. So it's kind of the opposite of what we were talking about earlier. So I didn't mean to interrupt you, John, but it did jump out at me as like a rip from the headlines kind of opposite case study that's really fascinating.
Yeah, I think that's an awesome example. And it's interesting because that company effectively traded with a, call it a risk premium, because this was a known possibility, right?
100%. I mean, this was what everybody feared. I mean, they could have done this and gotten away with it as a true take under, right?
Yep.
And bid below the market price or right at the market price, or, a 5% premium or whatever. And instead, this is effectively going to be, look, the operational results have been awesome too. So I think even at 82 euros a share, they're probably still not losing any sleep about paying this price. Let's put it that way. But look, what was the point too in not doing this years and years ago? They could have done it even cheaper 3 or 4 years ago, right? I mean, I think Ralph Sonnenberg's now like 80 years old. They already controlled 80% of the company. They already took dividends out of the company as needed on an annual ad hoc kind of basis to do whatever they wanted. They had more money than they'd ever need. why do it right as a pandemic is starting to clear, and then why raise the price when there's absolutely no reason to? No one could force you to. I mean, there's almost by definition, there's no chance that anybody here could have owned more than 50 basis points or maybe 100 basis points of the common stock, right? And then you're going up against a multi-billionaire family that owns 91% of the stock, where they legally have the right to just squeeze you out in a short form merger. I mean, it's a crazy situation.
And in the US, we actually do have, in theory, legal recourse in this case. Minority
Correct.
shareholders have appraisal rights.
Had appraisal rights. Yeah, but in this case, you did not. And by the way, that wouldn't have mattered. Like, this was not so egregious that would have been upheld. I mean, they were not taking the company at, some egregiously low price. I mean, as a non-lawyer, I'm venturing a guess here, but I would give you way less than 1 or 2% chance of having succeeded on appraisal rights, even if that was an option, which it wasn't.
Yeah, it's interesting because for a while, appraisal rights was actually like a strategy that some funds were deploying. And then suddenly courts decided that, actually, we're going to say some appraisals are below the value of the takeover price.
Right.
So not only have you tied up this capital and litigation expense for a prolonged period of time, you get marked down from where you could have gotten. And so it's not really a strategy anymore. But I think it's interesting to think about it. Theoretically, there's this helping hand to kind of prevent and discourage this sort of behavior, but it really has no practical application in the modern world. And I think that gets to those like abstractions that I was talking about from core market essence, in your section up top, Phil.
Yeah.
And this is a fascinating situation. I guess, Phil, you just made the point that they really didn't have to raise the price at all.
No, they didn't.
I'm kind of reminded of another situation in the last couple of years, I guess, with TK Offshore Partners that was taken private, acquired by a Brookfield asset management entity. And, they did it the way it could legally be done. And, there was this huge outcry among shareholders. Oh, Bruce Flatt, this is going to ruin your reputation. Not really. Bruce Flatt didn't really care, I guess, about that because, he was just pushing his legal rights, and that was that. But you have these kinds of situations come up, and again, I think yeah. Go ahead, Phil.
I was going to say, speaking of Brookfield, I mean, how about the Oaktree transaction? Right? What was that? 2 years ago now? I mean, that's a pretty interesting one, right? I mean, I have lots of respect for Oaktree as a firm and the great people who work there, but that raises some of these same questions, right? I mean, it's it was a controlled entity. It was never all that clear as to what they were going to do as a public company or why they really wanted this access to the public market so badly. And they were public for 6 or 7 years, maybe something like that. And I think they would admit that it was, not a great idea. And they went private, went right back into Brookfield's arms as a private company where they kept all the voting rights and economics. And, that's that, right?
Yeah. So management incentives clearly matters a lot. I think sometimes investors also kind of overplay their hand, if you will, or their analysis, and they think a company is suddenly worth, 5 times the market price. Maybe, but maybe not. I mean, you've had plenty of managements sell out cheap, not, just because they felt that was a good idea. I mean, think of Instagram, right? Terrible idea, but they didn't do it to screw anyone over. They screwed themselves over. So you got to kind of also keep it in mind that the management is not necessarily screwing you. It's just they may feel the price is fairly adequate. And again, their own incentives are going to deviate from the investors' incentives.
Yeah, it's such a tough, tricky area because once these things happen, you do tend to step up what you'd expect. In Nuance's case, I was hopeful that because it is a strategic asset, someone out there who is looking to get into similar areas might make an over-the-top bid. Unfortunately, it never came. So there is a market, right? There is this idea that if it is such a steal, someone else should be out there hunting. I think the Instagram example is an interesting one because at the same time, you could say the value would have never been as much as it is today had they not been acquired and had they not had the resource and the back end capabilities to leverage. I mean, it's interesting to think that I feel we're in a new era of M&A. When I was like coming up in this industry, a lot of people would say like, all M&A is inherently value destructive. And I think we've seen some of the more interesting, more fruitful M&A in recent times, though we've also seen some like spectacular blowups. Think about like Valiant and how big they went. I wonder what sort of coming out of this COVID period M&A activity there's going to be, because there's some companies that have way more firepower than they thought they would at this time last year. And they have incentives to make things happen. So it'll be, I'm eager to see where this goes from here. Certain sectors in particular, like you could see the case for a lot of consolidation, maybe even thinking more globally.
Yeah, that's a good point. Actually, in just the last couple of days or over the weekend, there was a big acquisition announced in the German residential apartment real estate space, where I think the biggest player, Vonovia, acquired Deutsche Wohnen at a decent premium, not huge. And they were going to control so much of the market that they turned around and offered to sell an apartment portfolio to the city of Berlin, I believe, or something like that. And of course, that's kind of maybe one of the lesser attractive pieces of their portfolio, because Berlin had some rent controls and stuff. So yeah, to your point, Elliot, there's definitely probably going to see some interesting transactions coming down the pike. And in this specific case in Germany, you would have been much better being on the target side than on the acquiring side. The target stock was up 15-20%, and the acquirer stock went down, I think, about 5% on that announcement.
Yeah, that's more traditional for what you'd expect in M&A, right? The acquirer has typically, I remember reading a paper on this like a decade ago, that the acquirer typically goes down on the day of the transaction because people are unsure what to expect. But maybe times are different, regimes are different, rates are low. So when you think of hurdle rates to actually realize net positive value to shareholders, it's definitely an easier recipe, especially for some of these companies that are overcapitalized to begin with. Look at Microsoft, how much net cash they've been carrying for a long time. Still ways to go to get totally optimized on a balance sheet perspective. I don't really know how to play it or how to like think about positioning for it. It's kind of like the strategic asset wrinkle I think of when I invest more as a put option than a call option in a lot of ways. And it's been helpful as such. I think about something like Grubhub for my personal experience, but it would be interesting to see it transform into more of a call option than I'd been thinking of it. I don't know. From a personal perspective, I'd had surprisingly little M&A. I went from 2013 through 2020 without a single takeover in my portfolio, and that was I had thought of it quite weird, because considering most of our book is like $2 to $10 billion market cap equities, where you'd exactly, I would think the range you'd expect more of that to happen. But then again, there's a difference between industries that are undergoing consolidation and industries that are not, and capital cycles in general. So I've really liked that marathon framework that we talked about in an earlier podcast about capital cycles playing out. Clearly, you could tell I haven't had much exposure to semiconductor space, but that was one of the M&As I experienced in 2020. Do you guys use it as an explicit part of what you look for anywhere ever, or is that just a good fortune cookie when it happens?
What's that, M&A?
Yeah.
Look, so there was a time where it was this a long time ago now, but I used to go prospecting for community banks that were takeout targets, particularly if they were former mutual conversions, because there were, these were 100 million to 2 billion size market caps. So they were relatively small. The access to information was pretty good, but there were just very few people looking, and the incentives got pretty clear pretty quickly, right? So, I mean, you could go looking around and say, who'd passed the various anniversaries on their demutualization. You could make a few calls. I mean, I remember the first time the light bulb kind of clicked was I started homing in on this area in New Jersey that was ripe for consolidation. And there was one bank that was just a super obvious takeover target, and I couldn't figure out why it hadn't been taken over. Nobody seemed to know. And I called a few of their competitors, and they basically said, oh, yeah, well, as soon as Jim, the CEO, had his heart attack last year, I think everything changed. And sure enough, 6 months later, they announced a deal at a 50% premium. So that kind of stuff is definitely out there. I think community banks are, there's still 3,000 plus of them out there, and the vast majority are going to be consolidated away over the next 20 or 30 years. So that stuff is out there. I mean, that's an explicit example of what you're talking about. Other than that, I think it's really tough, right? I mean, it's inherently still speculative, right? And even in something like community bank, I mean, I wouldn't want to make it the primary thing that I was looking for, right? Because if I get the first whiff of a bad credit culture, right, or a business that's not run properly, or a weak balance sheet, or whatever, like, it doesn't matter how likely I think a takeover is, because it's inherently a tough game to speculate on. And likewise, I mean, that was my problem with Hunter Douglas was, the possibility of a big premium was there, and this premium is going to end up being something like 75% over my cost basis. So it's awfully painful in that regard, in terms of I missed most of that. Was it a dumb decision? I mean, partly, I guess, but I thought that the operational issues they were having, combined with the management, kind of hide the pickle game, was just not a great sign for what was going on. It was relatively hard to get information. It was clearly a controlled company, so it just didn't seem like a great setup. And as you get into other things, I mean, years ago, I was involved with a company that was just horribly run, and it was totally obvious that they were undertaking a sales process. And sure enough, I mean, they were sold to a private equity firm within 6 or 8 months. And so, I will go looking for those types of situations where I think things are totally lined up in your favor, but the sword cuts both ways, I think.
Yeah, it's interesting. You just made me remember an example from my history of this like controlled company that doesn't really want to talk. And I still like the company, but I, sold my stake similarly too soon, though not ahead of M&A. It was Johnson Outdoors. So the family, the scion of S.C. Johnson and Co., had started as a side hobby, like a kayaking company, sells kayaks. And they expanded and acquired like a suite of outdoor activity assets. And, it was extremely cheap, had a ton of net cash. And it's Helen Wood Johnson, who's, I'm blanking on who her husband is, who owns the Minnesota Wild. But, they wouldn't talk to anyone. They wouldn't give you any information. Their calls, like, no analyst would show up. So you'd have this, like, maybe 5 minutes of prepared remarks, and you're like, well, what do these people think? Like, what are they doing? What are they in this for? I feel like those situations are inherently tricky. Phil, I'm curious, you said mistake with Hunter Douglas, but would you consider the mistake having bought it in the first place, or having, sold it instead of the M&A?
No, I mean, I guess the mistake would be, they had this history of tendering for the stock kind of cheap, and that's not a problem or a sin, right? So I guess I almost outthought myself, or got too cute with it, because I think the fear was at the time that, okay, the operational issues are real. Like I'd confirmed that. And by the way, they were about to turn the corner. So the one thing that may have tweaked their conscience a little bit was that when they announced this in late December, it turns out that the quarter they were finishing right there was just awesome. Like the results they announced in late January, February, whatever it was, were just amazing, right? So, but I was worried about the opposite, right? Which was going to be that, they're clearly retaining this option to do a short form merger, and that they're going to pull that trigger right after they have a really bad quarter and the stock's down like 20%. Which would have been, down 20% from where I bought it, basically. And then they're going to offer like a 5% premium, right? And there's nothing stopping them from doing that. Like, all the activist letters in the world would not have stopped them from doing that, right? It's truly just their own incentives and their own conscience. So again, given the supply chain disruptions from the pandemic, and this was, May, June, July, August last year, given the demand picture that certainly came into view and I was getting more optimistic about, but, there were still some uncertainties at the time. I mean, my concern was just that, all right, these guys are not really playing it too straight with me right now. The incentives are quite clear for them to just retain control. I mean, they did cut off the dividend last year, which was an interesting choice, right? Because that was basically their only source of liquidity as a family. Not that they needed lots of personal liquidity, but that was a super conservative move, right? So to go from paying a pretty generous dividend to paying no dividend means that like they're really worried about something, right? It's not like they had much debt on the balance sheet either. So like that was a pretty bad sign. And it all just proved to be kind of a combination of a head fake and just a short-term problem. And whether I misread the situation or miscalculated the odds, I can see it both ways. It certainly wasn't a great hand of poker that I played. That's for sure.
Yeah, I mean, I wouldn't be shocked in a situation like that where you fear effectively what they do is purposely sandbag all their numbers and just let the floor, kind of like when a new CEO comes into a company. They almost always want to reset expectations, knock things down, and start building up from like hurdles they could step over instead of jump over and set their comp accordingly.
Right.
It's been fun reading Non-Gap's Substack and learning about the dark arts of corporate governance and just, opening my eyes to how frequently this sort of stuff plays out, even in companies where like they're not controlled and where this sort of kind of option is not on the table, just how much of it goes on. And I think it's changed the prism through which I view some of these situations. And it's put some interesting setups on the table, like just pay attention to when management's acting greedy in different kinds of ways. You get huge signals from it. Especially management teams who have a history of not acting greedy. Like if you suddenly see them acting greedy, perk up your attention. Like what's driving this? So yeah, I think maybe probably our most recurrent theme is incentives and management. So I really like it. Clearly something about it that resonates with all of us. And I think there will be continuing meat on the bone to chew with this one.
Well, thank you guys. Terrific discussion this week. As always, really enjoyed it. I hope everyone listening did as well. Phil, did you have any closing remarks?
No, I think that covered it. So thank you both for your contributions here to my my little 2-page guide to life. So I'll be sure to send this around.
Terrific. Thank you all. Talk to you next week.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.